Hello and welcome to Trading Hour. I'm Surabhi Upadhyay, and with me in the studios today are Sonia Shenoy and Pavitra Parekh. Girls, good morning.
Good morning.
I don't know for the bulls whether it's a good morning at all, considering the way we've got this big slide going, right?
Absolutely. I mean, it's not a good morning at all. You know, if you look at it even now, the market is at the lowest point of trade. And it just goes to show that there is plenty of pressure that you're seeing as far as the bulls are concerned, right? I mean, not just in our own markets, but globally as well. So the Nifty is now down, 160 odd points. The next level I think that the street is watching out for very closely is the 200-day moving average of 17,349. So we've sliced through all levels, whether it's a 20, 50, 100-day moving average. And now the next level to watch is the 200-day moving average of 17,349. Adani Group stocks are seeing a sharp fall in trade this morning. So that just gives you an indication that the sentiment is really on the weaker side. So whether it's Adani Enterprises, now down almost 7%, you know, the other Adani Group stocks as well. But I think the big theme globally really is what's happening with the slowdown in consumption, right? When the largest players, Walmart and Home Depot, talk about barely 2.5% growth or a fall in profits. If they are going to slow down, then the question is what happens to the rest of the world, and especially what happens in India. So I guess that's going to be a big talking point over the next many days.
Oh, absolutely. And in the US, it's such a flip-flop. One day it's a soft landing. The other day, okay, there's no landing. We'll just take off. The economy is very strong. Third day, we're back to saying interest rates, you know, whether the Fed will stay higher for longer. That's the new catchphrase, right?
And then there's a recession that's coming as well.
And one day the recession's coming, the other day it's kind of... So it is confusing. The cues and the market's interpretation of a lot of the data points that have come over the last couple of days, it's just kept things flip-flopping on the higher side and the lower side. I think the key watch points really remain what's happening to the dollar index and the 10-year yield. And both of those two signals are flashing red. Asian markets right now are, of course, down and out. The dollar index up on your screen above 104. That's the decisive move that we got yesterday as the equity market slipped off. And if you're looking at the 10-year yield in the US, it's pushing close to 4%, 3.9 to be more precise. And this risk aversion is really what's playing out across equities. We saw it on Wall Street overnight. And Asian markets this morning, look at Taiwan, look at Hong Kong, or the Japanese market for that matter. It's just, you know, pretty much a sea of red out there in Asia. So what we are witnessing here on our street is no exception to the rule. We're just part of this global equity rout that has set in on this Wednesday. By the way, Pavitra, this is the 5th consecutive fall day in India right now. So yeah, it's becoming a long streak of declines.
Oh, absolutely it is. And you know, talking about that flip-flop that you were mentioning, like Sonia mentioned, Home Depot, Walmart saying that sales are under pressure, but also, I mean, we had retail sales figures which are roaring, right? For January, it came in well above what was expected. In that context, the cues that we have lined up over the next few days will be important. You have the FOMC minutes today, so that is important to track. Domestically, of course, RBI minutes, FNO expiry tomorrow is, you know, something that we will watch. But since Sonia and Surabhi have taken us through so much bad news, the one spot of green is, you know, what's happening to some of these white good makers. So take a look at, say, a Voltas, you have Symphony, you have something like a Blue Star, which are doing well in this otherwise very weak looking screen. So they're up for you on your screen. Tech, by the way, we saw that huge sell-off on the Nasdaq. So, of course, tech opened weak, but all of these have recovered significantly. I just have 3 or 4 of the larger names on your screen, but they've come off the highs, all of the high point of the day. So, do keep your eye out on that. What's not doing well, once again, it is the PSU Bank Index, you know, which is under pressure the most. This year already, it's almost down 16%. Some of the larger names will be up for you. SBI, of course, is leading this, but, you know, even if you take a look at the mid-caps, the likes of Bank of Baroda, Bank of India, Union Bank, these ones seeing some cuts as well.
So, you know, in that context, I mean, the bank Nifty, I was just looking at it. Now for the year, it's down 6.5%. So that's a steep fall. And you were hoping that it would sort of get compensated by the IT moves. So far, IT has been doing well. But in the last couple of days, IT has also faltered. So when two leaders of the market are under pressure, then perhaps, you know,
we were really relying on IT.
Absolutely. I think, Sonia, you really identified an important trend. Even I was thinking about that it was just the IT, you know, island of IT, which was kind of getting us home all this while. That seems to be changing, at least today.
Oh, absolutely. So let's kickstart the show. We have lots happening in the next 1 hour. We invite Naveen Kulkarni, the Chief Investment Officer of Axis Securities, to discuss key fundamentals and stocks to watch. Naveen, welcome to the show. You know, that's the big question, right? What is ailing banks? I mean, after having a great year, 2022, banks have suddenly collapsed, SBI especially. Do you think that this is a time to be accumulating? do you think the common narrative is that this whole net interest margin up move that banks have seen has now played out entirely? So things could change this year. Your thoughts?
Yeah, so if we look at banks, typically banks are leveraged plays on the economy, right? So, and the expectations are very, very clear, right? So expectations of slowdown are very clear. And there are lots of reasons why we can think of that 2023 will probably be a slower year. So in that context, of course, high beta plays and leverage plays like bank will see a correction, right? So that's something which is expected. But having said that, the most important factor which is in favor of the banks is, of course, the fundamental strength, right? So as things progress through the year, I think banks should continue to do well. If you look at, let's say, FY24's earnings composition, banks will probably be the biggest contributor to the pie, right? So from that perspective, I believe that at these levels, one should definitely accumulate banks. One can be a little more careful in terms of looking at quality and balance sheet, but otherwise, I still believe that banks should do well over the course of the year. We should see healthy returns coming from the banking sector.
Naveen, I was looking at this CIO memo that you put out, right? I think it's a monthly, release that you do. And I found that analysis pretty interesting on what the so-called smart money in the market is doing and whether the smart money is actually looking at other asset classes. We're talking banks. I mean, let's face it, the benchmark yield is now touching 7.4%. And equities have been just dithering, and we don't know how long this lull lasts. So is there some merit to the argument that there's some asset diversification, asset class diversification that's happening? What are the ultra HNIs doing?
Yeah, so that I think is a very, very clear trend, right? So if you look at the overall context, right? So if I were to talk about, let's say, an ultra HNI, right? So ultra HNI is not just exposed to India; he's exposed to the world, right? He looks at asset classes from Europe, from US, from India, from Japan, right? Everything. In that context, of course, the India equity return expectations have moved up meaningfully, right? So they used to be around 12 to 13%, probably a year back. Those numbers have shifted to around 15 to 16%, maybe 17% also, right? So the expectation of return from Indian equities has increased, primarily because the let's say dollar debt is yielding much higher. Then you add the currency premium to that, and then you add the equity risk premium. We will come to that number of around 15 to 16%. So that definitely means that we would see some bit of diversification playing on, and this will be the painful period, right? This is the painful period that we have entered in the, let's say, next 6 months, and this we'll see people will allocate to different asset classes, and then once the expectations rationalize, we should start seeing money again coming back to Indian equities in a more meaningful manner, considering the strength that we have, economy is pretty strong. All those fundamentals will start making more sense.
All right. Hi, Naveen. Good morning. This is Pavitra. You know, in this context, when we are talking about the kind of expectations from the Indian market, it is also in large part hinged on the kind of earnings we can expect, right? We were just talking about the Q3 season, which has gone by. There are more misses than hits. What do you think will happen here on? What is the kind of earnings growth that you expect? And how much of a bearing do you think that will have on the market?
Yeah, so as far as the earnings growth is concerned, if we saw the overall composition of earnings for, let's say, Q3, there were misses in sectors like, let's say, metal, summit in oil and gas, right? So those kind of misses we saw, which are primarily sectors which don't get very, very high multiples, right? On the other hand, let's say some bit of consumer staples did actually much better than consumer discretionary also, which are typically the high multiple sectors. Companies like ITC did very, very well. Then, of course, the banking sector did well. So overall, I don't see a meaningful change in the earnings growth trajectory because one sector missing, other sector doing well is pretty much cancelling out the challenges. So from that perspective, we should see a 12 to 13% earnings growth. Question, of course, the challenge will lie with the valuation multiple. We are right now a little over closer to one standard deviation above the mean. So that is still a challenging area. We might see some bit of compression in terms of multiple. It could be in terms of time or it could be in terms of absolute correction. But overall, I feel that market should trend in line with the earnings growth over the next 12 to 15 months.
Actually, that is a very interesting conversation that you all were having on ultra HNIs and where they're parking their money, right? Because I was just going through a Capgemini World Wealth report of last year. And they say that in the Asia-Pacific region, the largest contributors to the ultra HNI category has been India and Taiwan. And in the last 1 year, the ultra HNI segment in India has risen by 10.5%. I mean, that's not a small amount. So where do you see these people parking their money, Naveen? You spoke about how offshoring is also a big, big theme right now. But within the Indian markets, do you see a lot more participation from this category? And if yes, what are the themes or sectors to look at?
Yeah, so the ultra HNIs, as I was saying, or typically, let's say the large investors, the activity definitely has reduced in the Indian market also, right? Because they don't believe that there is significant returns that they want will be achieved in the immediate term. So they are in a wait and watch mode. At lower levels, we'll definitely see more activity happening. Having said that, the sectors which are, of course, going to be interesting right now is that at this point in time, it's not bottom up. That's one theme which is very, very clear. Sectorally, of course, we have banks look good, automobiles look good, some spaces in the industrials look good, right? But I think this is a year one where one has to be very, very careful in terms of the stocks they are picking, and one should be buying businesses and not just playing market cycles. From that perspective, some of these leading sectors, and there are good number of plays in these sectors, which one can look at and one can accumulate and have a concentrated portfolio, which can deliver a sizable return in the next 12 months.
Okay, Naveen, speaking of portfolio, we just have 60 seconds left on this chat. I'm looking at some of the changes that you made. I think in your growth strategy, you've added Praj Industries. And in the contrast strategy, there are quite a few sells. You've sold out of ICICI Bank's ESC, added Wipro, actually. I have to ask you about Wipro. They're slashing salaries for freshers. Just a quick take on that, and leave us with any high conviction bet that you may have.
Yes, so we have a wide range of high conviction bets. So, for example, in the automobile space, Mahindra & Mahindra is definitely a high conviction bet for us. Considering the kind of product launches that they are having, the growth that they are delivering, that's definitely a high conviction bet for us. ICICI, we did cut a little bit of position, but with still a significant overweight on the stock. So that is something which will continue to do well for the next 12 months. You just mentioned Praj Industries. So Praj Industries is one of our favored stocks, which has got the right mindset in terms of solving the problems of, let's say, carbon footprint. They are into renewable energy, right? So they are all into the right spaces. That space, I think, will continue to do very well for the next 12 to 24 months. And I think, considering the order book and everything that Praj has, I think the earnings growth will be very, very strong over the next 24 months. So we are quite bullish on the kind of these names that I just mentioned.
Okay, just one final question before we let you go. Is your sense that this market is going to see a steep fall, or are we just looking at a time-wise correction for the rest of the year? I'm asking because, now there are some serious concerns about perhaps a fall coming through as we head into a global recession. But your thoughts?
So typically, if we are to see a steep fall in the market, that will most likely be short-lived, right? So because the fundamentals are reasonably strong in India, and if, let's say, we go quickly down to something like a 16,000 levels, we might bounce back also reasonably fast. But what I would say in the overall context is that this is a market which will take its own time to actually slowly move up, right? So in the short term, we might see a 400, 500 points correction, and the market might continue to languish for some time, and then start seeing a move up. I don't see a huge correction coming for market. That I think I would rule out. But it is going to be a reasonably tough market where the up moves will be slowly coming through, and there will be down moves also, right? So this is that kind of market. Low volatility and slowly ups and downs and things like that, right? So that's the kind of market that we are going to be in.
All right, got that. Naveen, thanks a lot for joining us today and taking us through your call on the market as well as some of these individual sectors that we just spoke about. We do have to get into a short break now. The market, by the way, is at the low point of the day. It's an over 150-point cut that we are seeing on the Nifty. The Nifty Bank almost 500 points in the red. We'll talk more about that, but for now, let's slip into a short break. On the other side, we also have a discussion on the commodity space with Manisha Gupta. Hey guys, welcome back. You're still tuned into Trading Hour here on CNBC-TV18, and as promised, let's talk about the commodities space now. Manisha joins us, and today she's going to talk about something very interesting, which it seems like energy traders are diversifying into other commodities. Manisha.
Oh, well, yes, Pavitra. We have been talking about this for some time on how agri-commodities and other commodities as well have been attracting a lot of capital and a lot of leverage trading as well. But this is a data that McKinsey now has actually put out in numbers. So yes, major energy traders, whether it has been about Gunwork Group, Hartree Partners, Vitol, and these are all major energy traders globally with very huge numbers under their portfolios, and Mercury Energy Group as well. So while they have been trading into energy, but because energy has big linkages with other trades as well, we have seen a lot of money from these companies go into other commodities as well. Well, remember, it was in 2014-15 that we saw major trade houses and some banks as well let go of their agri-commodity traders because they did not see much meat in profits there. But all of that seems to be changing right now because some of the big names from agriculture sector, from banking sector, seems to be joining these companies now only to trade in metals, mining and agriculture as a space. Also, the energy crisis, the Russia-Ukraine war has led to trade linkages into the markets. High gas prices also curbed the metal output. They also boosted the fertilizer prices, and also energy and food sector in any sense do compete for the biofuels. So we are seeing linkages coming in for that from that space as well. This data is quite interesting, which tells you about 2020 and 21 with the kind of money that many of these traders have made. So globally, when you look at the trade, while of course power, energy, gas, these commodities continue to do double-digit billion dollars of trade, as you can see in 2020 and 21. But there has been a good gain when you look at the agriculture as a sector as well. In 2019, it was $3.4 billion of trade that was done in agri space. By 2020, it was $6 billion, and we have seen those gains continue into the previous year as well. Metal and mining as a sector clearly is showcasing very big numbers here. So from $31 billion in 2019 to $48 billion in 2020 to $52 billion in 2021 is how we have seen that trade grow up. So clearly big names joining trade yet again. Money is also getting deployed and huge profits, as you can see, clearly being made in the space.
Okay, thanks a lot, Manisha, for that. Well, the market is definitely not showing any signs of recovery at the moment. The Bank Nifty is still down about 500 points. So good time to take a break. When we come back, we'll ask Mitesh Thakkar on how to approach the markets for the rest of the day. We'll also discuss some top trading bets. Do stay with us. Well, there's plenty that's bogging down the market. One, of course, is global. Locally as well, there's a consumption slowdown that people are talking about. And all of that has put a bit of pressure on the market. We're joined by Mitesh Thakkar of earningwaves.com for a quick technical check. Mitesh, how are you feeling about the Nifty right now? This 200-day moving average of 17,350 thereabouts. You think it could be taken out very soon? And what is the prognosis for the rest of the day?
Good morning. So I'm not sure whether it will be taken out immediately, but I think we have a very strong case for going and testing that level. The idea is that today we had a gap down, and yesterday we were talking about the fact that the intraday indicators had slipped into sell more, and today we had a gap down, and the daily indicators now are turning negative. So 17,500, which was the earlier lows, I think should be tested, most likely violated, and therefore 17,350 becomes the next logical target. So yes, I think playing for some kind of a negative movement in the markets over the next few days. We have some negatively bearish biased option positions on the index, and on the stock side also we are now exploring shorting positions.
Okay, so that's on the index. Mitesh, considering the mood is so somber, stock calls, what would you go with? And I mean, as a contrarian approach, would you look at buying anything right now?
So we're not buying anything, to be very honest. I think, now looking at stocks which are breaking down and exploring short positions. In fact, on the recommendation side, I have BHEL and Bank of Baroda as the sell calls. BHEL recommend a stop of around 71 for targets of 65 on the downside. And we had earlier Canara Bank in the morning as a sell call. Now I think Bank of Baroda also features on the list. It's a sell with a stop just above 160 for targets of 148.
All right, Mitesh, thanks a lot for joining us with that quick technical check. But let's now talk about NMCC Steel. This is one of those few stocks which is doing well even today. In fact, it listed on Monday and, it has been locked in upper circuit for the last 3 trading sessions. Nigel caught up with Sumit Deb, who's chairman and managing director of NMCC, to discuss the outlook for the newly listed company. And he began by asking him, of course, about the commissioning of the new steel plant. Listen in.
So the steel plant has taken some time to get all the facilities ready, but we have now currently the coke oven battery 1 is already in operation since October. We would be able to start the sinter plant very soon, in a couple of days time. The coke oven batteries 2, and obviously a steel plant needs to have various phases, various units which get commissioned in phases. And next would be the blast furnace and the steel melting shop and the thin slab caster, which we expect to commission end of March, April, beginning of April.
Okay, all right. So by April, we'll have the steel plant finally getting commissioned. Are we getting that correct?
Yes.
Okay, so what should be the rough number in terms of volumes you're looking at for FY24? It's a 3 million ton plant. Given the ramp up could take some time, what would be the realistic production volume you're looking at?
I don't think I can give you a number at this stage with regard to production, but definitely a million ton, 1.5 million. So would be the a million ton would be the correct picture.
Give us the updated debt number.
The debt is around 5,000 crores is what we would ideally be looking at over a period of time.
Just to get that debt number correct, sir, I understand that the current debt is close to around 2,800 crores approximately. So you're saying once it gets commissioned, the peak debt will be close to around 5,000 crores.
That is correct.
All right. Now, NMCC was supposed to buy close to around 10% stake in this venture. What's happening out there? Have you all fixed the price? Will NMCC be buying that 10% or more or less?
So this is the process which is being run by the Disinvestment Ministry, that's DPAM. And yes, 10% is what NMCC will have to buy at some stage of. And having said that, we have not yet come to the pricing of the shares.
Okay, all right. And how soon could this happen?
Yeah, that is some timeline which I'll not be able to predict because it is being run by the Disinvestment Ministry, so they will be able to give us a correct picture. However, it is on target.
Okay, all right. So NMCC has to buy 10% stake in this particular unit. The street has a split opinion out there whether or not it's lucrative or not. Bulk of them believe that why should NMCC be wasting money on this steel plant? But do you want to justify that?
So this steel plant is located in the Bastar region of Chhattisgarh, and the nearest and we are the only iron ore suppliers to the steel plant. We shall be the major iron ore suppliers to the steel plant. It is also a logistical challenge to that extent, and there are other issues related to it. So yes, definitely this was a good idea to retain 10% stake in the steel plant at the moment.
All right, that is NMCC telling us that the steel plant will be commissioned by April of 2023, also saying that steel volumes will be between 1 to 1.5 MT. This is for FY24. But on that note, we are going to get into a short break. When we return, a lot of stocks are in focus today. We'll tell you why when we come back. Hey guys, welcome back to Trading Hour. Let's now talk about some stocks which are in the news today, and we are going to start off with Workhorse. This one is surging following the company's investor meet. So Ekta is joining us to take us through all of the takeaways from this meeting. Ekta?
Thanks for that. Well, yes, Workhorse was in focus because of the investor meet that they held after a hiatus as well. And a couple of key takeaways has actually enthused investors to look at Workhorse today. For example, they did indicate that there would be annual savings of around $12 million, which is via restructuring of the business. Restructuring of the business would include the shutdown of their manufacturing facility at Morton Grove. The agreement that they have with Serum for vaccine manufacturing at their UK facility, they have received £10 million as a contribution for reserving capacity. Remember that this particular agreement is for 150 million doses across 15 years. And Serum has identified 2 vaccines as of now for this agreement. The company also plans to manufacture post the regulatory approvals as well as exhibit batches. So that should probably come on stream 8 to 12 months from now. Now, in terms of the R&D portfolio that they have, the novel antibiotics, one particular antibiotic in their portfolio, which has in fact been launched in the Indian market, is Mroc, and they expect approvals in 8 emerging markets in the next 6 to 9 months. Now, WCK5222 is another product which is in their R&D scope of their business, and that is a novel antibiotic as well. They expect to market the product in key geographies such as US, China, India by 2025. Now, importantly, in terms of the balance sheet, the long-term debt of the company has reduced significantly. It's come down to around 608 crores, and compare this to FY17, where the peak debt was over 3,200 odd crores. Lastly, the promoter has also indicated that they are entirely and fully committed in the business, so that has probably enthused investors further.
Okay, thanks a lot, Ekta, for that. Well, we're also looking at Voltas this afternoon. We've been talking about it for the last couple of hours. Where Voltas, it was up about 4%. Now it's cooled off a little bit. The IMD, of course, has released a report that there's a big heat wave coming in the month of March itself. They're talking about the western region hitting 37 degrees Celsius in March. Now, there are beneficiaries in the form of all white goods companies, whether it's Voltas, Symphony, Blue Star. Jefferies has an aggressive target price on Voltas. They have a target price of 1,050. They say that this early heat wave definitely points to improved volumes and a margin outlook. And in both their segments, ACs as well as engineering, the volumes are expected to move up, and Voltas is in a sweet spot. The stock has also underperformed quite a bit. So in the last 1 year, it's underperformed the Nifty. Hence, there is a headroom in terms of a stock up move as well. In fact, we spoke to R.K. Genamani of the Indian Met Department on the heat wave conditions in the country and what the prognosis is. Listen in.
South Rajasthan and almost Gujarat and Konkan. So almost last 7 to 8 days, the temperature, 5 to 11 degree above normal. And Bhuj reached around, 40 plus around something like Shivaratri day, that is maybe 18. And concern is the, impact on the agriculture, because as you know that it is in full, this is flowering stage, whether it is Madhya Pradesh, whether it is Punjab, Haryana, wheat belt, and even a large part of India, it has a, very big acreage and crops. So we have given yesterday, first time, the special advisory because the temperature high, so we don't want to, keep this information. We want to flash it, and we are monitoring very, very seriously day to day. Yeah.
Okay, so that was the IMD telling us about the severe heat wave conditions. Let's move on to the next stock that's on our radar, and that is Prestige Estates. The company held an analyst meet. Sonal is joining in with the key takeaways as well as what the word is on the street on this one. Sonal.
Well, yes, this analyst meet was held in their new market, that is Mumbai, and there were substantial commentary and comments made, at least as far as their future plans are concerned. The company says they plan to double their residential sales by FY26. Right now, it stands around 13,000 crore rupees, so they're expecting 25% CAGR over a couple of years to reach that 25,000 crore mark. In terms of contribution, Bengaluru continues to be the bigger market, but their contribution is expected to decline to 40%, and Mumbai contribution is expected to go up to 20% to around 5,000 crore rupees. Right now, it's around 2,500 crore rupees. Not only in the residential segment, in the commercial segment, they expect their lease income to go up by 7 times in 5 years. They're planning to double their hotel business to 3,000 keys by FY27 as well. So big targets that they've put in place. For this, they are looking at free cash flows of around 20,000 crore rupees rupees because of the residential pipeline that they have in place, 40% of which they will utilize in expansion plans for their leasing business and hotels business as well. They also expect to spend 2,500 to 3,000 crore rupees annually on new project additions, and the capex that they're talking about will lead to a higher debt, around 12,000 crore rupees, but that is something that they're comfortable with at these levels. Jefferies says that successful Mumbai expansion demonstrates its abilities to execute and also ambition to scale. However, they're awaiting their entry in the NCR region because there's already a lot of competition there. Office demand is weak given the tech slowdown. However, they are well diversified in the commercial segment. They have a target price of 560 rupees per share. That's Jefferies. MOSL says they maintain their estimates and they are watchful of the execution capabilities of Prestige and the business development as well. Cash flow generation from their residential projects will be enough to fuel their capex plans as well. They have a buy rating with a higher target price of 675 rupees per share. So bullish commentary from both the management and brokerages as well. Okay, thanks a lot for that. Sona, let's slip into a quick break. On the other side of the break, we'll get you excerpts from our exclusive conversation with Tata Power's Praveer Sinha on the power demand, the way forward. Stay tuned for that. Welcome back to Trading Hours. So for now, the market has not attempted any recovery at all. Later in the afternoon, or in the evening rather, we will be getting the Fed minutes of the earlier meeting, the FOMC meeting, and all indications are that there could be some more concerns on how, inflation fighting is not over just yet. Maybe rates could get higher as well. And all of that has, the hawkish Fed speak is something that has kept a lid on most markets' gains. So caution for our own markets as well. But earlier today, my colleague Lata caught up with Tata Power's Managing Director and Chief Executive Officer Praveer Sinha. She began by asking him what higher capacity utilization would mean for Tata Power. Here's a snippet from that conversation.
I think it's a very good move and a very timely move by Government of India to invoke Section 11. And this is because the demand of power is going up. In fact, this year, even in the winter months, we've seen the demand going to 205 and 206 as peak power. And as rightly mentioned by you, the peak in summer is expected to be 229 or maybe a little more than that. And to cater to that requirement, it's important that all our power plants, whether it is on domestic coal or imported coal, operate at full capacity, as also all the renewable plants and all the other generating capacities that we have. For Tata Power, it's very important because we have the imported coal plant. It's a 4,000 megawatt Mundra plant, which has been running, I would say, last year during the period Section 11 was invoked from May to December. And since then, we have been in discussions with the other procurers to finalize the supplementary PPA on similar lines as per the CRC order on Section 11.
First, overall, I wanted in terms of number of units. How much do you expect you will be able to generate in March, April, May, or rather April, May, which are 2 full months, compared to a normal month like, say, January?
So we have 5 units of 4,000 megawatt, and one of the units, of course, is down. There was some problem with one of the transformers. We hope we will be able to recover that by March. But all the 4 units will definitely operate at full capacity as we had been doing last year. And we should be in a position to offer the full capacity to all the 5 procurers.
Okay.
So you can expect that 3,200 megawatt will definitely come. And if we are able to revive the 4th unit, then the 5th unit, then 4,000 megawatt will get generated.
Okay. And you will be fully able to recover it either from the PPA, the guys who have signed the PPA, or from the exchanges at no loss?
So we will be able to, based on the Section 11 order of the CRC, it will be on a cost plus basis. That means full recovery of fixed cost and the variable cost will happen. And we expect we will get full pass through of all these costs.
Okay. So you are quite sure that you will not be left stranded with power generated but not consumed?
Absolutely. And then, of course, the provision is there that if you the DISCOMs are not scheduling the power, you can sell the excess power in the exchange and the difference can be shared. The benefit of that can be shared with the existing procurers. So I think it's a very fair arrangement that has been projected. And the purpose is that enough power should be available in the country to meet the growing requirement of power.
Tata Projects, there was a talk that there would be an IPO. Anything you can enlighten us since you are a 48% shareholder?
Nothing at present. We'll definitely come back if there's something planned.
Okay. And your own solar unit, you are not thinking of hiving it off? It'll all be one integrated unit?
Yeah, absolutely. We have set up a separate entity which is for our renewable business. And we are focusing on enhancing the renewable business in all the areas, right from manufacturing to EPC to rooftop. So I think we are very focused in our growth areas. And you will continue to see excellent performance from Tata Power.
Right. Just once more, if I can ask you that question in terms of higher cost. The price you charge now for 1 unit of thermal coal generated power and what it will be when you use the imported coal. How much can the difference be? Will it be 10% higher, 20% higher?
On a like-to-like basis, it may be about 10 to 15% higher. But on an overall basket, it will be a very, very small increase. It is, in any case, for a short period of time. And it is only impacting very few plants. So I think if you see in a basket, it will be a very, very marginal increase.
That was Tata Power earlier telling us about how they're reacting to, of course, the government's step of issuing what literally is like a preemptive strike against this peak deficit problem that we always see in the summer months. Stock, however, is still down to 2.5%, as is the rest of the market. By the way, it's almost a 200-point decline on the Nifty, with absolutely no sign of recovery. There are no buyers strike. It seems like it's a buyer's strike because there are no buyers. That's the shape of the market. We'll take a break on that note. We'll come back with some more stock action on the other side. Welcome back. So as we've been telling you, there's no really change in that commentary. It is a down day. There's no other way of putting it. And the pressure is only adding. I mean, there's a lot of momentum on the downside. And the thing is, there's no counterweight today. Every single major index, the Nifty index, the sectoral indices, is trending in negative territory. There was some green on the pharma space a while back, but even that's gone. And obviously, PSU, banks, real estate, that's where the pressure is being really, really felt. But otherwise, guys, it's, I mean, we're here at almost 12 and no signs of a respite whatsoever.
Yeah, oh, absolutely. I mean, right now there are, I think, maybe 5 stocks from the Nifty pack which are holding in the green, but no big gains to speak of at all, right? I was looking at some of the new age stocks which, have been in focus anyway, but they're also seeing losses only intensify right now. So take a look at Nykaa, Zomato, for instance, PB Fintech. These are some stocks which are only seeing cuts deepen. So that is what's really going on with the markets. But on that note, we will wind down on this edition of Trading Hour. Thank you very much for tuning in. Halftime report after this short break.